Wall Street has spent the last 2 years treating AI like the next industrial revolution. And maybe it is. But underneath the excitement, something is starting to break. Not the technology, the math behind it. Because the AI boom is no longer just about chatbots. It is becoming one of the biggest infrastructure bets in modern history. The biggest technology companies are planning to spend roughly hundreds of billions of dollars on AI infrastructure this year alone. That means data centers, more chips, more electricity, and more debt. The problem is not that companies are spending money. The problem is what they need to earn back. To justify this spending, AI revenue has to grow at an incredible pace. Not someday, soon. And that is where Wall Street is getting nervous. Because every bubble begins with a powerful story, and every bubble ends when the numbers fail to support that story. So, is AI a bubble? First, we need to be precise. A bubble does not mean the technology is fake. The internet was real during the dot-com bubble, but many internet stocks were priced as if profits were guaranteed. That difference matters. AI can change the world and still be overhyped in the stock market. Those two things can be true at the same time. That is the uncomfortable part. And today, the biggest warning sign is not AI itself. It is the spending race around AI. Every major company is terrified of being left behind, and fear is expensive. When companies are afraid to miss the next big thing, they often spend first and ask questions later. And that is exactly what is happening with AI infrastructure right now. Here is the strange part. A huge amount of AI spending is flowing in circles. Big tech companies buy chips. Chip companies sell the hardware. The chips go into giant data centers. The data centers power AI models. The AI models are sold back to businesses, and those businesses are expected to create enough demand to justify all the spending that came before it. That is not impossible, but it is a very high bar, because data centers are not cheap, chips are not cheap, and electricity is definitely not cheap. So the AI economy has one massive question hanging over it. Who will pay enough? Will businesses pay? Will consumers pay? Will governments pay? Or will companies keep subsidizing AI with their existing profits? That is the part Wall Street cannot answer yet. And when markets do not have answers, they usually replace answers with optimism. The first crack appears when spending rises faster than revenue. The second crack appears when expectations become impossible to meet. And the third crack appears when investors stop believing. Because markets do not need bad news to fall. They only need less good news than expected. That is how bubbles usually crack. Not with one giant explosion, but with small disappointments. A company misses revenue estimates. A data center project gets delayed. A customer decides AI is too expensive. A company cuts its chip orders. Then suddenly, investors start asking the question they should have asked earlier. Where are the profits? Not the future profits. The profits now. This is why AI valuations are fragile. They are built on a future that has not arrived yet. And the longer that future takes, the more expensive the bet becomes. Recent market selling shows investors are beginning to worry about exactly this. Whether enormous AI spending, often supported by borrowing, can keep producing returns fast enough to justify the price of the boom. Now we get to the part nobody likes talking about: debt. When companies spend billions building infrastructure, they have two choices: use cash or borrow. The largest companies can do both. But borrowing changes the equation, because debt does not care about your vision. Debt wants payments, and higher interest rates make those payments bigger. That means AI projects need to earn more just to break even. This is why the AI boom is not just a technology story. It is a credit story. It is an energy story. And it is a real estate story. Because these data centers are physical assets, they cannot disappear with one software update, and they cannot easily be repurposed if demand slows. That is why overbuilding is dangerous. If AI demand stays strong, this build-out looks genius. If demand slows, it can look like a very expensive mistake. And that is the risk Wall Street is trying to price right now. Not whether AI works, but whether the money being poured into AI can earn an acceptable return before the bills arrive. But before we call this .com 2.0, there is a major difference. Many of today's biggest AI spenders are already profitable. They have real cash flow. they have real customers, and they have real products. That makes this different from the internet mania of '99, but different does not mean safe. The dot-com bubble was about companies with no profits. The AI risk is about companies with huge profits, spending those profits on a future that may take longer than expected. That is a very different kind of risk. It is not about whether the companies survive. It is about whether investors get the returns they were promised. And markets can punish disappointment very quickly, even if the company itself remains healthy. That is why the AI bubble debate is so confusing. The bulls are not crazy. AI demand is real. The bears are not crazy either. The spending is enormous, and the payback is still uncertain. The most accurate answer may be that AI is both a real revolution and a market where expectations are becoming dangerously expensive. So, what could actually cause a bigger crack? There are 4 things to watch. Number 1, slower AI revenue growth. If companies spend more but earn less, the market will notice. Number 2, lower chip orders. The AI boom starts with hardware. If chip demand slows, the entire supply chain feels it. Number 3, rising interest rates. Higher rates make debt more expensive, and expensive debt makes risky projects harder to justify. Number 4, competition. If AI models become cheaper, then the companies selling AI may make less money per customer. That is great for users. But it can be bad for valuations. Because Wall Street is pricing many AI companies for massive future margins, and competition can crush margins fast. The key word is not collapse. The key word is repricing. A company can still grow, and its stock can still fall. That happens when investors realize the future will be good, but not as perfect as they imagined. So, is the AI bubble starting to crack? Maybe. But that does not mean AI is finished. It means the easy part may be over. The part where every AI announcement sends stocks higher. The part where spending is automatically seen as a good thing. The next phase is harder. Now companies have to prove that AI can make real money. Not just attract attention, not just attract investment, but generate returns. Because eventually, every boom meets the same question. Was it worth the money? Right now, Wall Street is betting the answer is yes. But the cracks are appearing because the price of being wrong is getting bigger. This is not a prediction that AI will crash. It is a reminder that hype does not pay the bills. Revenue does. And in the next few years, that difference could decide who wins and who gets exposed. Because the AI revolution may be real, but the price Wall Street is paying for it may still be too high. If you want more stories about money, markets, debt, and the hidden risks behind the headlines, subscribe to Money Uncovered. Because the biggest financial stories are usually happening long before everyone else notices.